Hello and welcome to the Daily Aus. I'm Billi.
I'm Sam.
Yesterday afternoon, the Reserve Bank of Australia announced it is lowering the cash rate for the first time since 2020. The cash rate was 4.35%, but it is now 4.1%. It's big news for Aussies, particularly those with a mortgage or who are wanting to apply for a home loan for the first time. And it's also big news for the Labor government, with this likely now impacting when we will go to an election. If you're confused about any of that, you have come to the right place. We're here to discuss what a cash rate actually is and how it will affect you whether you have a mortgage or not.
To be totally honest with you, I feel like the once a month announcement by the RBA on whether the cash rate goes up or down or stays the same is the moment where a lot of people go, I feel like I should know why this is so important and everyone's talking about it, but I still don't know.
Yes.
And so no matter how long this takes, we're going to go through the mechanics behind this and why you should care. Because cash rate is something that has come up in recent years, probably more than ever.
Just quickly, Sam, I have to pull you up. You said it's once a month. It's actually not anymore. It's less frequent than that. There's about 10 a year now.
Okay, well, if that doesn't give you a sense that I live and breathe news and I didn't actually know that, then I think everyone can relax listening to this knowing it's okay not to know a heap about this.
Absolutely.
Let's start with the cash rate. What is it?
Great place to start. So the cash rate is the rate of interest that the Reserve Bank of Australia charges banks for short-term loans.
Okay, and we're pretending we didn't get taught this in school. What is the RBA? What is the Reserve Bank?
So the Reserve Bank of Australia, also known as the RBA, is Australia's central bank. And so they're not a bank that is accessible to the public. They're more a bank for the government and also for commercial banks. But it's not like you or I could go to the RBA and ask for a loan. Absolutely not. It's just for the government and commercial banks. And their main aim is to ensure that the economy is stable and that the price of things don't rise too quickly. And so to do that, their key responsibility is to set the cash rate, which is what we're talking about today. And like I said, this is the interest rate that the RBA charges commercial banks to borrow money. This almost always flows through to other interest rates across the economy, which is why it's often used interchangeably with interest rates. So this means that the cash rate, if passed on fully by the banks to the public, so the banks that you or I would use, Sam, the cash rate will impact the rate of interest on loans, including mortgages, and it will also impact the interest on savings, which is not something that we often talk about when it comes to the cash rate. And the higher the interest rate, the more expensive it is to borrow money, but also the more interest you receive on savings.
So the RBA sat down this week. It was actually a 2-day meeting that concluded with this announcement. How do they actually make their decision on what to do with the cash rate?
So they mostly base their decision on something called underlying inflation. Now, when we talk about inflation, we usually are either referring to headline inflation or underlying inflation.
So let's go through headline first.
Okay, headline inflation measures how much goods and services have increased over a period of time, usually over 12 months. So that's the one that we most commonly hear about in the news. But then there's underlying inflation, which is what the RBA focuses on. And it's similar, it measures the rate of price growth, but it removes extremes on either side. So for example, if there's a sudden fall in energy prices, or even if there's a sudden increase in the price of apples, it doesn't include that. It's just looking for how the middle 70% of things are moving.
Okay, and so they take all of that data, they crunch it up, they work out how the economy is performing, and they set a cash rate, which is the objective with that is to make it move either up or down or stay the same. How does that actually impact inflation though?
So the cash rate, as we have seen in these past few years, means that people with mortgages have less money. And as I was saying before, higher interest rates make it more expensive for you to borrow. And that is what the RBA wants in this case.
Why do they want that?
Because if you can borrow less money, then you can buy less stuff. And that means that there is less pressure on demands for goods and services, and that should stop prices from going further up. It really is a balancing act. Are you following though?
I am, and I always actually like to think about coffee with this. And so if I'm understanding correctly, what you're saying is if the RBA puts the cash rate up, then people in a neighborhood aren't going to have as much money to go and buy coffee. Yes. And so when the coffee shop tries to put prices up from $5 to $5.50, people aren't actually buying the coffee because it's too expensive.
Exactly.
And so they keep it at $5. Prices don't move up as quickly, and the RBA has achieved what they want.
That is a perfect explanation.
Probably a little bit idealistic for how the economy actually works, but you get the idea.
Yeah, and that's why the cash rate is used as a tool to fight high inflation and to bring inflation down when it is too high, which is exactly what the RBA has done. One other point here, to keep going with your coffee analogy, is that when inflation goes down, that doesn't mean that prices are going backwards. So this isn't about your $5 coffee going down to $4.50. It's just about it not going to the $5.10 or to even the $5.50 as fast as the last 50 cents increase.
Okay, so we're not going back to the glory days of $3 coffees. We're kind of here now.
Yeah.
But it's about the speed at which we move to the next price point.
Yes. And just a quick tangent. I always think about this. Like, one day, are we going to be paying $15 for a coffee? But that's just how the economy works. Anyway, that will send you into a spiral.
That is a whole nother podcast. We're going to leave that to one side. There is so much in this, Billi. Can we just stick to what you're talking about with underlying inflation?
Yes, I just wanted to give you an insight to my 3 a.m. thoughts.
Fantastic 3 a.m. thoughts. I also have memories of older members of my family talking about going to the movies for 1 shilling and all of that kind of stuff. All right, too much economics talk is going to hurt everybody's brain.
Okay.
What's the RBA's aim for that underlying inflation bracket?
Okay, so the RBA wants the rate of underlying inflation to be between 2 to 3%. So that means that it wants the average price of goods and services in Australia to increase no more than 3% over a 12-month period.
Okay, and what is the rate of underlying inflation right now?
So it's 3.2%.
So that is just outside that target range.
Of 2 to 3%.
But it has been coming down for a while though, right?
Exactly. So underlying inflation actually peaked at 6.8% in December 2022, right at the tail end of the COVID pandemic. And it's been on a downward trajectory since then. So now it's less than half of that. And it was that year, 2022, that inflation really started to increase at a concerning rate. And it was also 2022 that the cash rate also started to increase.
So talk to me about that, and talk to me about the cash rate since 2022, because it was 0.1%, wasn't it?
Yeah, it was at 0.1%. That was during the pandemic. So they first introduced that cash rate in about November 2020. And that was a record low. It had never been that low before. So that was massive. And the whole idea at the time was to prevent the economy from collapsing because of the sudden arrival of the pandemic, which obviously no one was expecting. And the RBA wanted people to be able to borrow money easily and spend that money to avoid a recession. Another one of those jargony words. We won't get into that. But basically, they wanted people to spend their money. Exactly. So it was at that rate of 0.1% from November 2020 to May 2022 when it started to increase. And it was on a consistent increase until it reached 4.35% in November 2023, where it has remained at that level ever since.
So it hasn't moved since November of 2023?
No, it has stayed at that level. And to give you some context about the last 25 years and where the rate has been, that rate of 4.35% was the highest it has been since November 2011. So this was obviously big news when it reached that level of 4.35% in 2023, and it has been a huge topic of conversation since, and I hope I don't have to say any other years because
there's a lot of calendars in this.
I'm tumbling over all of the years, but I hope that you're broadly following me.
So it gets set at 4.35% at the end of 2023. We've sat there since. We're now in February of 2025, and there was a cut.
There was a cut. It went down to 4.1%, and that was the first time it has gone down since 2020. The reasoning for the cut, the RBA board said in a statement, and I'm reading here, in the December quarter, underlying inflation was 3.2%, which suggests inflationary pressures are easing a little more quickly than expected. These factors give the board more confidence that inflation is moving sustainably towards the midpoint of the 2 to 3% target range. So hopefully now you kind of have all of the context to understand that quote. And you'll notice a lot of the coverage from news outlets focus on what this means for mortgage holders. And just to give you an idea of what it does mean in real terms, someone with a mortgage of about $600,000 will be paying about $100 less in their monthly repayments.
And we know a lot of our audience doesn't have mortgages. We know a lot of our audience, young Australians in particular, are renting. Some might not even be in the housing market at all. They might still be at home with mum and dad. What about for those without a mortgage? How is this going to impact them?
Hi, I'm Zara. I'm the co-founder of the Daily Aus, and we started this company because we think news can be done differently. If you agree, you can hit subscribe. It's the best way to help us grow. Now, back to the video.
So for savers, this cut to the cash rate is actually less positive. So if you have savings in a bank at the moment, you'll notice at the end of every month, you will get an interest payment. Now, because of this cut, likely there will be less interest that you are earning on that money.
So you get marginally less, probably, if your bank passes on the interest rate cut. And as a saver, you make less money from having your cash in the bank.
Exactly.
One other thing I want to talk about before we leave it there, right at the top, you talked about the impacts that this could have on the federal election, which we know is going to be before the middle of May. Talk to me about the political implications of all of this.
Yeah, so as we have now mentioned many times on this podcast in many deep dives, Australia needs to have an election by the 17th of May. We still don't know when exactly that will be, and that decision is up to Prime Minister Anthony Albanese. What we do know is that cost of living will likely be one of, if not the most important topic that voters are voting on this election. And this cash rate cut is largely seen as a positive thing for the government, well, at least seen as a positive thing by the Labor government. So they will likely argue in the days and months to come that they have used their policies, their economic policies, to drive down inflation, so much so that our central bank is slightly taking its foot off the gas now. But on the other hand, we have opposition leader Peter Dutton, who we expect will make the argument that it has been under the Albanese government that rates have risen so quickly and that inflation has been so high. And it's likely that Dutton will say that a single rate cut won't relieve the cost of living pressures felt by Australians over the past few years.
It's a really interesting one, that last point, because it's worth mentioning the RBA is not politically influenced.
Yeah.
It's an independent institution, completely independent from whichever government is in power of the day. And that doesn't change the fact, I guess, that both sides of politics, for as far back as we can remember, have used RBA decisions for their political gain or to perhaps score some points off the other side. But it's worth mentioning that the RBA sits outside of government.
Completely independent.
No matter which party is in power. And I think that's probably enough jargon for today.
Thank you so much for coming to my economics lesson, Sam.
I think that was very good. That was very good. It's a really tough topic, and thank you all for sticking with us through that. It's a really important part of our economy. Hopefully, we gave you a bit of a rundown of how it all works and why the decision by the RBA yesterday was so significant. We'll be back this afternoon with some headlines. Until then, have a good day.